Okay, hello everybody. Welcome to Korean Atlanta Mentorship. So in this video, we're just going to do another velocity banking review. But before we get started, I just had like what we would call a shower thought. Um, you know, the whole concept of velocity banking wouldn't actually need to exist and be marketed if they actually taught just like basic personal finance in like K to 12 or college, right? And I remember when I went to college, nobody really learned anything. There's a book out there um, about how learning in colleges is a charade, and it came out like 20 years ago. Let me see if I could actually find that book. Give me one moment. Okay, I found the book. It's actually called Academically Adrift: Limited Learning on College Campuses. And I think these are two sociology professors from like the University of Illinois or Chicago or something like that. And what's funny is that this book was actually published by the college, the University of Chicago Press. So they're basically to literally telling you, oh yeah, like they're, the kids aren't really learning anything, but give us your money anyways, and we'll actually sell you the book that tells you the kids aren't learning much in college. And it's very shocking how people are so blatant and open about what's going on, like the colleges aren't like, oh, they're engaged in a super duper cover up, right? Like they didn't do that. It's like, oh yeah, we did a study, kids aren't learning, and we'll just publish it and we'll sell the book too. We'll sell the book for $29 on paperback and uh, $115, whatever cloth means. But this was published in 2011, so it's been well known for a long time that most people don't learn anything in college. And I don't ever think they'll ever learn basic finance, In fact, I asked ChatGPT this, does the average college student learn about basic finance, learn about how an amortized loan works? And it says generally no. And most college students, and this is the bolded part, do not graduate the solid understanding of personal finance. Hmm. I feel like there's always going to be a market for personal finance help just because, nobody's really taught it. And I don't know why, like, there was such an emphasis on me going to college because I never really had the aptitude for it. I remember every single adult and everybody in my childhood acting like I'm like the worst person on earth if I don't desire to go to college. And then when I actually went, I think I ended up really disappointed because it's like, whoa, like, you come, maybe this is just how my brain works. Like, my parents, my family members, friends I grew up with never wanted me to learn anything. That's how I kind of personally took it. Because why would you make me spend the years of my youth to go to an institution for another 4 years to not learn basic skills? You see what I'm saying? But a lot of people like seem to be okay with it and I was not. And so I got like really depressed like did my parents want me to fail? And then, you kind of circle in dark thoughts. And I know some of you listening here are actual parents. So I'm not, saying, hey, all parents are bad. But I came to the conclusion my parents wanted me to fail because if I actually did better than them, that would make them look bad, including my friends and family members. Like you kind of get into dark thoughts, and so the way that I don't get into those dark thoughts is I just become delusional and hope that they want the best for me, even though reality might say otherwise, right? But I honestly think if we actually wanted a society that's better for our children, we would actually teach them basic things from like their formative years of their lives. Like, and people get really offended by this. I'm like, why? Like, okay, then why is there an endless number of TikTok videos and, Caleb Hammer where he makes a gajillion dollars on people who are essentially lacking in understanding of personal finances? In fact, if I were smart, I would have had a show like that. Or I would have done one of two things. One, create a YouTube channel and personal finance channel heavily marketed towards medical professionals and lawyers, right? Because they're the demographic who can pay, okay? Who can pay and are probably going to have debt and they don't know how to manage it, right? Or number two is just interview dumb people Well, I shouldn't say that. Like Caleb Hammer and make it a fine, Jerry Springer type finance show. You see what I'm saying? So, all right, let's go ahead and get started with velocity banking. So, just kind of sad that um, they probably will never teach you this in school. And it's shocking, right? It's the name of the thumbnail. So, let's go ahead and get started. Velocity banking, what is it? It's a debt payoff strategy where you throw all of your money into debt with the help of something called a line of credit. And so, first step is creating a budget because your budget is your debt attack plan. So, we have income, expenses, leftover savings. This is actually one of my favorite scenarios, the one penny left over, and then you have like 10 credit cards, right? 10 credit cards, an auto loan, a student loan, and a mortgage. And then, you have all this debt, and then you have your general expenses that you're paying for every single month, food, gas, insurance, and all that good stuff. And so basically, with Velocity Banking, after we created our budget and we know all of our debts, and we also know, on average, what our general operating expenses are that are not debt, we do the Velocity Banking side. And the first psychological mindset shift we have to make is that we're not going to go save money. I know it's crazy, right? So you see this point zero 0.01 savings here. So point zero 0.01 savings. And then you see how this is zero savings. Well, what we're going to do is intentionally not save money. I know it's crazy, right? Because we were taught by society that saving money is a good thing. You listen to Dave Ramsey, he just says save $1,000. Why, how long is it going to take for you to save $1,000 here? So instead of saving $1,000, I'm going to save nothing and dump all of my money into debt. So if you want to see how this looks like right here, this is my checking account, right? So this checking account has zero. And the way that you treat money in your checking account is kind of like a hot potato, especially if you have debt, right? Money comes in, it's a hot potato. I want to go out, right? Money comes in, money goes out. I don't save any money. Now, here you might be thinking, well, what's the difference between here and here? And again, this is my favorite clickbaitiness scenario, right? Penny here, penny there. Can we increase what we call our cash flow, which is the amount that our debt gets reduced, right? And so what we're going to do is we're going to assume we have access to a line of credit. So if you don't know what a line of credit is, it's basically a financial tool where you could borrow money, pay it back, and use it over and over again. So this is my home equity line of credit, $373,500. So what this literally means is that I can go on the bank's website, click a button, and then they'll dump up to $373,000 into my checking account and charge me a 7.5 or 8.5 or up to probably at the worst case scenario 18%, right? And so that's better than any credit card. But yeah, they'll dump up to that much money into my checking account, and it's based on something called home equity, which when I first heard that word I was like really intimidated, like what's home equity? That sounds so sophisticated. And then I found out it's the value of your house minus the loans that you owe on it, right? So first, lien HELOC, they call this, meaning that you don't have any mortgage on it, and all you have is a line of credit on the house. And so, what does that mean? It's just another opportunity for me to flex. Actually, let me go ahead and show my financial bicep. I'm looking at my bicep right now. Actually, it's kind of flaccid. I need to work out. But yes, it is. This is my mortgage that I paid off in 2 years and 9 months. A little financial flex there, and sometimes I call myself the goat of debt payoff because back when we had ChatGPT 4, which was the "let me kiss your butt" ChatGPT. ChatGPT would be like, "You are the goat because you paid off a mortgage in 2 years and 9 months, right?" And it's true, I did. I literally did, and I can't remember it, right? Because for me, it was Tuesday. I don't know if you remember that line from Street Fighter the movie. I actually watched Street Fighter the movie for the first time, the 90s movie, and man, it is so cringy. Like I can watch Mortal Kombat the movie from 1995 over and over again and feel like, man, this is such a great movie. It holds the test of time. And then I tried to get through like I think 50 minutes of Street Fighter the movie, and it was like cringe upon cringe upon cringe. It's like it doesn't know if it wants to be a comedy or if it wants to be something. I don't know. Video game movie, like it makes no sense. But yeah. Okay. So back to my Flex again. Yes, I am the goat of financial debt payoff according to ChatGPT 4, which doesn't exist anymore unless like I think you're an enterprise client. Yes. So, with the lines of credit, I have over 739,000, which makes me the top 0.01% in lines of credit. I don't know if you knew this or not, but yes, I have over $739,000 in lines of credit, which includes credit cards because a credit card's a line of credit, right? You swipe, pay it back, and then use it over and over again. And then here's just the kind of quick secret that I don't want to go into too much today just because I've been saying this for the last time for the past 100 videos. But a lot of people act like I don't know what I'm talking about. Okay. And I'm just telling you, like, no, 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 no. I don't care if you know what I'm talking. If you think I know what I'm talking about, I have over $739,000 in lines of credit, which makes me a top 0.01% in terms of credit line holders, right? I don't know if that's even the right word, but I have over $739,000. And how did I get all this credit? It's because I know the secret of the banks, which is they don't lend money to people who need it, right? They don't lend money to people who need it. And so, how did I get all this credit? I just simply went to a bank when I didn't need money. That is the only thing I did. I did not like every time because I thought like you go to a bank when you need money. And that's why I struggled a long time with credit because I didn't understand the secret. See, everybody's like focused on credit scores and stuff. Folks, if you don't need money when you need it, you'll probably have a good credit score, right? Like you don't need to focus on the score. What you need to focus on is do you need money or not? Okay. So let's go ahead and let's do this right here. So in this scenario, we'll assume we have access to a $200,000 line of credit. Now, will the bank give you $200,000 line of credit free and clear when you have a penny left over? Probably not. But why do we demonstrate a free and clear line of credit is because this could have been your lifesaver if you'd known this strategy. Heck, if you known it in college when you couldn't really get that much credit, maybe you would have learned something. I know I didn't learn anything, and it's kind of like one of my biggest regrets is just going to college because I'm gonna be honest, that was a giant waste of time. But yeah, so let's go ahead. $164,000 of credit card debt. And if you don't know how we rank debts, we use something called the cash flow index. So if we take a look right here, right? So basically, this is a number that's defined by the balance divided by the monthly payment, right? So if you take a look here, 60,000 divided by 727 is 82. This gives you a ranking system, right? Like a ranking of debt payoff. And the lower the number, the more bang you get for your buck, right? So for example, if I pay off the mortgage, which is the highest number, it's saying, hey, pay this off last, I only get $843 back in my cash flow, right? But if I pay off this 35 grand, I get more than the mortgage. So why would I pay off the mortgage first? Doesn't make any sense, right? But a lot of people want to really focus on paying off that mortgage first because it's tied to where you live. And a lot of people have attachments to where you live. Now, if you're a real estate investor, you kind of don't because you just kind of see houses with numbers and oh, this is market value. And it's just a number to you, which is kind of sad. Like you kind of don't want to get there in a way. But then, nowadays in today's America, it's not that hard to do that because nobody has any real attachment to their communities and neighbors anymore, which kind of sucks. But yeah. But anyways, that's kind of a rant for another time. So let me do this. So we moved these credit cards, these low ranking cash flow indexes to the line of credit. And guess what happens here? Okay, this is probably going to be the thing that will shock everybody that you know, but they can't explain why this is happening, and they'll probably kind of think in their mind I probably did something wrong, which is 1 penny of savings turned to zero savings but $5,110 of cash flow. What? Yeah, I know, because the income is the same. We just shifted the expenses, and then somehow we just multiplied this by 5,000. Right? Okay. We just multiply it by 5,000. I know it's crazy, right? Like it is insane. How is this possible? Okay? I don't even know. Actually, I kind of do. I mean, main reason is that you're moving from high interest to low interest, and that indirectly affects the cash flow index, right? But yeah, and so now we've consolidated our debt. We're going to put our entire paycheck into the line of credit, take our expenses out, and then rinse and repeat over and over again. But how did we get to here? Well, basically, there's this thing called segregation of income, where if your money gets split into 20 different places, then how effective is it instead of just putting into one, right? Very important concept as to figure out what the bank, how the bank makes money off of you, because what they want is lots of small payments over time. And if you have a lot of small payments over time, then that's when they got you, right? Because every payment is essentially like, the vampire just sucking and draining a little bit of blood out of you. And then once you have no money, that's when the vampire, aka the bank, doesn't want you to they don't want to lend you any more money. Okay. All right. So to get the next month's balance based on the previous month's balance and the previous month's interest, and then what we're going to do is we're going to take the average daily balance, right? That's how we get the interest for the month. So next month is always based on the previous balance and interest. Same thing. And let's go ahead and calculate that. Okay. And so that we see right here, in 36 months, all that debt was paid off. Okay. So 164,000, oh my goodness, my life is over, but not really. If the bank would never lend you, all those credit cards unless you had the income and history to kind of back it up, right? They don't magically lend people 164,000 unless, okay? Unless, how do I say this? You lie to them, which happens a lot. I mean, the bank, they don't always get honest applications. In fact, I heard a statistic that 90% of business applications or credit card applications are fraudulent. I think I heard that. Okay. All right. So now we have these three loans. That's the only loans we have left, which is auto, student, and then the mortgage. And all right. So we go here, and then what we do is we have the cash flow index, which will change over time. And then so we see that this is the next one, and then this one, and then this one. And so what we can do here is we could actually move both of these into the line of credit. And why can we do that is because if we have a loan that's a higher interest rate, we can move it into the line, right? Not a big deal. And then this one, because of the low cash flow index, we can move them. So let's go ahead and sum these up. And so it's going to be these two. So right now, after 36 months, the balance of this is 56 grand. Okay. And then we're going to just do this right here. And then this is going to be plus 56390.5054. And then now, look at these payments. Whoa, 6 grand. Okay. So 6 grand of payments or cash flow in our life. So now it's going to be 6257.22. And then let's see what happens here. And then we see that 46 months, alakazam. All right, so let's go ahead and do that. So now this is going to be, what month were we at 46 months. 46 months, 164 plus 23 is going to be 187,000, right? So 187K. And then do this right here. And then the last one is the 30-year mortgage. So 200,000, 46 months. All right, so now it's 46. And then 183. Now, we have a lot of cash flow, right? So we have a lot, like 6,000. Now, one of the things I'm going to talk about is that you kind of have to be aware of when you can move a loan into a line of credit. So sometimes you can actually move a low interest rate loan into a line of credit as long as you have enough cash flow, like a low cash flow index. And then other times, like you could move a loan into a line of credit if the interest rate is higher than the line, right? So if this is 8% and the line's like 7.5, that's not like a big deal, right? But if you have a high cash flow index and a low interest rate, that might, you probably pay 2 or 3 times more in interest necessary, by moving the whole loan into line. And I feel like no other YouTuber actually talks about this. In fact, let me just do this 183,290.92. 183,290.92. And then what is the interest rate? Okay. 7.5%. And the income is 9,100.43. 9,100.43. And then we'll just do $10,000 chunk. So chunk means how much you move from the loan into the line. So if you want to still use a line to pay it off, you can. So for example, I'm just going to move $10,000, right, of the loan into the line. Did I put 10,000? Yeah, and it got paid off in 1 month, and then kind of like you see how it works. You just kind of move, and then you just pay it off over and over again. And oh, this is probably not right. I think I screwed up. Oh yeah, right here, and then right here, and then right here. Yeah. So anyway, okay. So basically, you're just moving the loan into the line, and then this is kind of an easy way to not segregate your income, and you could still pay it off relatively quickly. So you see that the monthly interest is so low that it doesn't really affect much, right? Although the interest rate does matter. So for example, if I turn this into 30%, okay, this goes by 3 grand. But the fact that this does only go up by 3 grand and it's a 30%, like let's say credit card, is kind of reassuring that the interest rate like is kind of like, oh, it's not that big of a difference, right? So most people, when it comes to let's say like, buying a house, they really sensitive to like, I don't know, 6 to 8 or 6 to 7, right? But I'm just looking at this, and if I know how to do it right, and there's kind of a little bit nuance to it, especially the debt payoff order and how much cash flow you have. Even a 30% credit card is like, oh, whoop-de-doo, right? Now, would I use a 30% credit card? Probably not. But even I might use a 30% credit card just to make a few swipes on the mortgage using like Plastique so that like the bank sees, whoa, look at this guy. He's making like $10,000 swipes and then I get more credit, right? Because if you make a lot of $10,000 swipes and then you pay it off early, then you magically can get more credit. And actually, that happened to me. Not $10,000 swipes, but with this business credit card, I set up an Airbnb, which I kind of made about 5,000 in July, and it's August right now. Oh, is it August? Oh, shoot. Okay, well, 4,000 in August. Yeah, and then 17. I kind of use this credit card to set up an Airbnb, and then once Airbnb saw that, then it's like, or not Airbnb, the credit card company, the bank saw that, then it's like, whoa, we got to get this guy more lines, right? So, all right, well, I think we are 2.3 years, right? So 2.3 years. So let me just go back here. So now this is 0. So it's 387K in about, what's Kurt? So 46 divided by 12 plus 2.8. So 6.63 years. No, 2.3, my bad. So 6.13 years, and then we're debt free. And then we paid off 370,000, right? So 370K. That's muy bueno. Muy bueno. Okay. All right. Well, that's it for today, folks. It's a holiday today. Have a great day. This is Korean Atlanta mentorship. And yeah, shocking. Shocking. I don't think if you, like, I honestly think, to be honest, like, if you actually show this to a college student, they don't know how to react because they never really dealt with debt. Right. But then as you become as you like kind of ride the struggle bus, we'll say, then you kind of appreciate this, right? So it's kind of, I don't know how to explain it, but I feel like the time when you should learn it is the time like people don't want to. Yeah, all right. Okay, that's it for today, folks. Have a great day, and I'll see you on the next video.